partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast number 319. This Moving Iron Podcast is brought to you by Ag Direct. No matter how you buy your ag equipment, whether it's from dealer, an auction, or private party, Ag Direct can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com. I have got Tanner Ehmke back on here from CoBank to talk about what's happening over in the marketplace. So Tanner, how you doing, man?
Doing great, Casey. Great to be back again.
Merry Christmas to you and your family.
Merry Christmas.
Going to be cold. So this is the coldest Christmas I think I can remember. Well, I mean,
It's gonna be really cold.
Leading up to Christmas are cold. Christmas Day is not too terrible bad, but negative 9.
It's going to be pretty chilly.
Yeah. -9 is going to be really cold. So looking forward to that. And that's the hot part of the day. So looking forward to that. So
Do reindeer fly in that kind of weather? I don't know. I mean, that's pretty tough.
Gonna be that wind chill is gonna be something. I can tell you what, they might lose a one or two. All right, man.
I don't want to tell my daughter that we had to postpone Christmas because it was so cold. Reindeer can play.
That'll go over well. That would be my kids, dude. Don't be like but yeah,
It's a failure in parenting right there.
Yeah. Sometimes I do that stuff for a good laugh, and it's not necessarily it's funny for a minute, then it gets old quick, I guess. But all right. So we got a couple things happening right now. One, we've got, obviously the Fed came out last week and raised interest rates. The thing about Jay Powell kills me a little bit is what he says during the Fed conference where they raised rates, and then what he says after. He came out afterwards and said this is going to be a long, hard fight with inflation, and we're going to have to just bear down and grin and take it. I mean, like 2 days after, he was like, there was a very positive theme to what he had to say about raising rates, and now he was talking about he kind of went completely the different direction there. So I guess, looking at what he said and raising of the rates and those kind of things, Tanner, looking at the overall economy right now, what are your thoughts there, and how do you foresee more long-term interest, whether they raise them or leave them the same? I guess what's your thoughts there going into 23?
Well, I got a couple of thoughts on the latest move when they raised rates half a point instead of 75 points like they done in the prior four meetings. I think the Fed is trying to claw back some of its credibility that it lost a year ago when it said that inflation was transitory. And they want to display themselves as an organization that is data-based. And when they were saying all that transitory talk a year ago, that was all kind of conjecture. It was not data-based. And so now here they are a year later, and the markets are having a hard time believing what they're saying when the Fed is making these statements. They're going to continue raising rates well into 2023. Throughout 2023, or that it's going to be elevated, and then not till perhaps 2024 until we see a decrease. The markets are not really believing it because they burned their credibility. So he's got to make these statements over and over and over again that we're going to keep raising rates. And so when the data comes out that inflation is indeed coming down, it is slowing. They have to follow the data, and rather than getting ahead of the data. And when inflation has displayed several data points now of coming down after peaking over 9% earlier this year. Okay, now they've got some data in their pocket to where they have to follow through on what they said earlier, and they have to slow the pace of the increase. They have to demonstrate to the marketplace that they're taking data seriously. So now the challenge going forward is, as inflation will likely continue to come down based on what we've seen with commodity prices having coming down, having seen retail sales slowing with consumers and things like that. We're going to probably see inflation numbers still follow this trend of going down into 2023. The risk, however, is if the Fed takes its foot off the brake too soon, and this is what everyone's referring back to what happened in the 1970s with Arthur Burns. He was the Fed chairman back in the 1970s who saw a similar trend. He was coming off of high levels of inflation. The inflation numbers started coming down. He said, "Okay, we're done with our monetary tightening." And then what happened? The markets went berserk, or the inflation went out of control again because he took his foot off the brake way too soon. And Jay Powell is well aware of this. He does not want the legacy of Arthur Burns, of having taken his foot off the brake too soon and letting inflation spiral out of control. And then it was up to Paul Volcker several years later to finally get it to arrest that inflation and stop it from rising. And it was very painful. So he does not want that to happen. He does not want to be known as the Fed chair who messed this up twice after calling inflation transitory and then following up with taking his foot off the brake too soon, and then it gets out of control again. He does not want that legacy. So he has been making these statements over and over and over again. We're going to keep our foot on the brake. We're going to see what happens when the new data comes in. We're going to keep it. We're going to keep raising rates into 2023, and then we're going to keep our foot on the brake, and we're not going to lower rates because that would be too soon. We need to see that these policies, which can take up to a year really to go into effect, or till you see the effects in the economy, it can take that long. And so he's going to take a very, very cautious approach before he starts taking his foot off the brake because of what we saw with Arthur Burns back in the 1970s. So he's sending these statements. Yes, I see the data. Inflation is easing. And then he follows up with these repeated statements, but we can't take our foot off the brake too soon because we have to see what if our rate increases that we've done so far are actually having an effect. So he's being very cautious, and he's kind of hedging his next moves by transmitting these statements that, listen, take me seriously, please, because he really biffed it last time a year ago by making those statements about inflation being transitory. So that's the position he's in right now. It's got to be data-based, but he can't take his foot off too fast because you end up with the Arthur Burns problem and inflation spirals out of control.
Yeah. Okay. All right. So you talked a little bit about China there, what you're talking about there. What's CoBank's position on how inflation will be infected worldwide when you start looking at if China does come back online full at 100%?
Well, the concern, I think, around the world is not just CoBank, but anybody who's watching the markets and watching China, is that as they open up their economy from COVID, you're seeing a lot of hospitalizations right now. A lot of people do not have immunity to COVID because they were locked down and didn't get exposure to it. And they don't have an effective vaccine. And so as they do this quick reopen, we're hearing these reports of mass hospitalizations, and death rates are up. The mortuaries are in business. and it's been a rough reopening, and that's going to be impacting the economy. And I was reading this morning how it's impacting their economy in various ways. For instance, there was the latest blockbuster movie, Avatar 2, that just came out. And China, the last movie, Avatar 1, this we're going down a rabbit hole here, Casey, but the last one was huge over in China, but this time it was really disappointing. And why was that? All these people are afraid of getting COVID and they don't want to go to the movie theater, which means they're not buying other things. They're not going to shopping malls. They're still not going to restaurants. They're still not consuming like they used to. So because of the fear of the consumer, because of this very clumsy reopening, but they're going to have to reopen at some time. But it's very clumsy nonetheless because they don't have an effective vaccine. You've got consumers that are scared out of their wits. It's going to take time, and that's going to be impacting their economy, and that therefore that's going to be impacting their imports of all kinds, especially your agriculture. For dairy, for instance, it's going to be impacting their dairy imports, and that's the sector I cover mostly. So I think it's something that we're just going to have to keep an eye on. They have to reopen their economy. They cannot keep doing these lockdowns like they've done in the past. And I think the leadership in China has figured it out that that's not going to work. That is not sustainable. So it's going to be a rough reopening for the next quarter, probably. That's going to be impacting the Chinese economy. That's going to be impacting their currency. The Chinese yuan is going to go down conceivably with this rough reopening. And that's going to be thereby supporting the value of the U.S. dollar. There's going to be capital flight, all those kind of things that lift the value of the dollar. I think that would be the upside. There's probably more upside risk here for the dollar that would be impacting our exports, and paired with the weakening consumer over in China. So a lot of things there on trade that really all come back to China and how they manage this reopening. It's probably going to be a little ugly for a while.
Okay, that makes sense. So when you're looking at, let's talk about currencies then for a little bit. So you look at what the dollar's doing. Dollar's been sliding here over the last week or so. You've seen some up and down there, but this week it's really turning down. Take a look at what the Brazilian real is doing and what you see. You just talked about the yuan and those kind of things. So looking at how the dollar is positioning into the key export season for the U.S. dollar. I mean, for the U.S. Cropping year, I guess. What are your thoughts there, and how do you think that's going to affect 23?
Well, this being the key shipping season for grains and oilseeds, especially soybeans, that's going to help probably put some tailwind behind our exports. But you got to remember, everybody is still anticipating a huge Brazilian soybean crop coming on, so that's going to be bearish there. The sheer fundamentals of having a record large Brazilian crop coming online here starting in the next month. So I would anticipate, my feeling would be that with the dollar having come down off the highs, we're still high historically, right. But having come off the highs established back in August, we've kind of trailed off since. That's going to add a little bit more tailwind. But I think longer term here, we got to look at what happens in Brazil. And when that crop starts coming online, it's going to be a big one. And so I think the markets are going to have to be dialing that in. It's going to be a bearish influence on U.S. markets.
Right. All right. So one thing you've been watching a lot of here of late, you see crush rates have been really high. Just recorded a podcast, Sean Hackett, kind of around this topic. Crush rates have been high with soybean crush rates. And then you start looking at this thirst for biodiesel that we're starting to see emerge, whether it's on the aviation side or whether it's on just the actual over-the-road diesel side. So I guess looking at that, you start taking a look at the number of acres it's going to take to really make an impact with biodiesel, like ethanol is made. There's a lot of acres that need to go to soybeans to make that happen. Has CoBank thought about any of that? And what's your thoughts there going into 23 as planted acres might start peeking its head here before too long?
Our grains and oilseeds analyst, Ken Zuckerberg, authored a piece on that earlier this year. And it was a really popular piece. It's one of the most read pieces we came out with this year. Yeah, I think perhaps it was the number one. It was one of our most popular research pieces we did. So I encourage you to go to cobank.com and read that. Now there's, the renewable diesel story has been the highlight of 2022 and the prior year. A lot of crush capacity coming online, and with diesel prices really having been so high this year compared to gasoline prices, that's created more of a thesis there underneath renewable diesel. It makes more sense to blend that alternative fuel. And so I think that's obviously been a positive there for renewable diesel because of the diesel story. It's just been, we're lacking in diesel supplies, and that's lifted diesel prices, and that's put a floor under renewable diesel prices and soybean oil prices. Now that's going to change over time, but that's really been the key success story here. Now, where do these soybeans come from over time? The market's going to work that out. We'll see how fast the capacity comes online, and if how much exports we lose, and how Brazil will backfill those exports over time, and Argentina, by the way, they would backfill that. But right now, Argentina is struggling with the drought. But it'd be a shifting of bushels around the world, and a lot of those soybean bushels will be kept here in the U.S. while Brazil backfills those export markets.
Mm-hmm.
Now, it just takes time for the markets to work that out. But right now, there's clearly a positive trend for soybeans. It was soybean acres. Ken Zuckerberg would have more insights on what he thinks, what that looks like coming up on this spring. But I would imagine there would probably be a trend for more soybean acres, especially in those flex states where you have a lot of other crops, like Kansas, for instance, where a lot of acres shift between corn, wheat, soybeans, and sorghum. There's more flexibility in the rotations there, where compared to like in Iowa, it's a corn, soy rotation.
Yep.
So I would say, my feeling, having been a grains analyst in my previous life, you got to watch those flex states, especially in the plains.
Right on. Okay. All right, let's jump over and talk about what your specialty is. Then let's talk a little bit about what's happening in the dairy market. A lot of fluctuation there because it's all revolving around, well, at least in my opinion, mostly revolving around high feed prices and what you see there. I mean, if you look at corn, if you look at hay, you look at all the components, silage and everything that's there, there's a lot of high feed demand right now. And it's very expensive to get that stuff to where it needs to go. Looking at the dairy market over the next going into 23, what are your thoughts there?
Well, you just said it right there. It's the feed story. That's not going away. The high cost on feed. As we head into 2023, we're going to be looking at what happens with acres between corn and beans, and we're going to have soybean availability because of the expanded crush capacity. But at the same time, you still have drought across the western half of the United States in key feed growing regions. And so that's going to be putting a floor under hay and corn prices. And as we see milk prices moderate and start slowly come down, because we have seen a response here in the United States and over in Europe, where milk collections have bumped up a little bit following a year of record high milk prices, farmers were able to increase milk production. And so milk availability has loosened up, and that's pulled prices down a little bit. Now, we're not going to see a collapse in milk prices. That's just not conceivably possible because the cost of producing milk is so high because of the feed story. And so we're not going to see a rapid increase in cow numbers because of that. And so we think that any correction to the downside is going to be limited. And then when we do hit that plateau, or that bottom, if you will, on milk prices, I don't think we're going to see a big shift later this year either, because I think farmers are going to be trying to maintain their herd sizes. So once you get further out into 2023, it obviously gets blurrier, but the first part of 2023, we're definitely going to see an erosion of margins at the farmer level. That being said, farmers are coming off of a phenomenal year of record high milk prices. There's a lot of farmers. This is probably the best year in milking cows they've ever had. And we are anticipating a lot of deferment of income into 2023 among dairy farmers. They're deferring milk checks with their dairy co-ops, who are our direct borrowers, and they're deferring that income into 2023 because this year was so good, and so they want to defer that tax liability into the next year. And so that's going to add some buffer to their balance sheets next year. So although we are anticipating an erosion of markets, an erosion of margins among dairy producers, I think what we've seen and what we're hearing is that it's not going to be a terrible erosion, and there is going to be some carryover income from this year.
Okay. So when you're looking at, my question just totally lost my question. I was going to ask you. Having one of those, what do they call that? A senior moment? Is that what they call it?
You're not that old, Casey. We're getting there, but we're not there yet.
Yeah, a good one too. It's probably one of those ones that was going to give me an Emmy. I can't remember what it was now.
When to short milk futures?
If you don't know that, just keep that to yourself. We can talk about that offline. Looking at on-farm income. So looking at on-farm income right now, as you look across, a lot of government payments are going to be going away in 23. What's CoBank's thought about that and how that's going to affect what they see happening as far as on-farm income goes?
Well, similar to what we're seeing just in dairy, this is going to be a phenomenal year for net farm income. Most farmers, not all, but most, had an absolutely phenomenal year if they were able to produce a crop. And so, excuse me, and that's elevated, excuse me again, sorry, working capital. And so that's going to be carrying over into next year, adding a fairly strong cushion underneath farmers and ranchers as we see an erosion of margins across most of agriculture. And so I think, for the most part, I mean, we're next year is not going to be bad for agriculture. And so it's not going to be as good as this year because as commodity prices come down and production costs remain elevated, then we're going to see an erosion of markets. As you know, it's quite predictable. Borrowing costs are going to be going up. There are some positives I would point out, though, that we are seeing fuel costs trending lower. That's great for farmers and ranchers. We are seeing other costs like cost of construction materials. Those are declining as well. That's going to typically go down during a recession. So if you're wanting to build a new barn or add any new infrastructure on the farm or warehousing space, anything up and down the agricultural supply chain, those costs will be moderating in 2023. And so that's going to be helping take the edge off of any erosion of margins. But I'd say, as we look forward in the next year, there's clearly going to be a drop off of the record high incomes that we saw this year. And, but I'd also say at the same time, it's hard to say it's going to be catastrophic when farmers are coming into that year with so much cash. The working capital is going to be phenomenal.
Yep. Whoa. I fell out of my chair. So excited with that answer. I about fell out of my chair there. They had a, So looking on what's going on with that and how the on-farm income is coming, you're hitting on my next topic here. Finally here, just talk a little bit about inputs going into 23. We saw from 21 to 22, there were huge increases in inputs, obviously with shortages and supply and, Ukraine war and Ukraine-Russia war and those kind of things. The reports that I'm getting kind of a mixed bag. Some guys say, you know what, hey, it's not much different than what I saw last year. Some guys, man, this is a big jump from last year, which depending on when you bought, you might have bought before price increases and those kind of things. But, with CoBank, being a key lender to some of these co-ops that'll be selling these inputs, I guess, as you look at that, what are your thoughts about the inputs moving into 23 and do you have any real concerns about rising prices there?
Well, if you look at what's going on with fertilizer prices, again, Ken Zuckerberg, our grains and farm supply analyst, he's written about this a fair amount. Prices are trending off the highs, and that's an absolute positive. But compared year over year, they're still higher. Again, depending upon where you bought, when you contracted. I think the concern going into 2023 that even though prices are off the highs, we got to watch what's going on over in Europe, especially with their natural gas situation. And if they start getting really low on their nat gas reserves, we're going to start. That's going to be elevating their energy, their costs, their natural gas prices, and our natural liquefied natural gas or LNG shipments are going to go fill that market. You're going to fill that void. That's going to elevate nat gas prices here in the U.S. Nat gas is the feedstock for so much of our farm inputs, whether you're talking fertilizer or crop protectants. And so that's going to put a floor under prices here in the U.S. So I think the story is twofold there. Yeah, we're off the highs, but we're higher than we were a year ago. And you got to keep an eye in the next few months as we head deeper into winter and how much depletion of nat gas we see in Europe. That could further elevate fertilizer prices and other input costs here in the U.S.
Right on. Okay. Tanner, good stuff as usual, man. Folks want to reach out to you and get more information about what you're doing over at CoBank. What's the best way to do that?
You can see us on our website, CoBank.com. If you want to read our research, it's on the Knowledge Exchange tab, and we got all of our research published right there on the website.
Excellent. Good. So go check that out. There's lots of good information there for absolutely free. It's pretty, not very often you get that kind of information for free. So check that out. So
there's no free lunch, Casey. It's
everything has a cost somewhere in the line, right? Right.
There's a cost.
Yeah.
It's going out of somebody's margin.
That's right. That's right. That's exactly right.
I better stop right there. I want to keep my job. No, it's all to the benefit of our borrowers. We want to be of service to our borrowers, sharing our insights to help them navigate risks and opportunities.
Yeah, absolutely. A lot of stuff to navigate right now, for sure. So, Tanner, appreciate you being on the podcast, man.
Thanks, Casey.
Merry Christmas, Happy New Year if we don't get to talk between now and then.
All right, you too.
Hi, bud. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast and check out the video version of this over on the Moving Iron Podcast YouTube channel, which is cleverly named the Moving Iron Podcast YouTube channel. So check that out. So go to Moving Iron LLC for everything Moving Iron related. And I've got some blogs that get posted over there. So I'll hopefully have those posted here this week so everybody can check those out. Moving Iron Summit coming up here in Nashville, Tennessee, September 11th through the 13th of 2023. Check that out. If you're one of the first 150 people to sign up for that, Axon Tire picks up the first $50 of that registration fee. So if you're interested in doing that, send me an email at MovingIronPodcast, MovingIronPodcast.com, and I will get your name on that list. So with that, I want to wish everybody a Merry Christmas, Happy New Year. I'm going to take a little break here, so you'll hear from me probably back around the first of the year. So I greatly appreciate everybody and what you've done for me and this podcast, and guys like Tanner make it pretty easy for me to be successful. So with that, I'm Casey Seymour, Tanner Ehmke. Exclusive Iron folks. Out.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron, time and time again. Through the years you'll find us here. Moving